Hi, everyone. My name is Reed Cataldo, founding partner at Prysm Group. Thank you for joining us today for the session, Econometrics, Securing Your Blockchain Through Economic Analytics. We'll start off with a quick overview of the two host companies for today's session, Prysm Group and Flipside Crypto. I will then share an overview of the 1 hour agenda, and then we'll get started. So for background, Prysm Group is a blockchain economics and governance advisory firm led by Harvard-trained PhD economists, specializing in the areas of contract theory, social choice, game theory, market design, and monetary economics. We have worked with many of the industry's leading projects, first starting in macro and microeconomic design. We then began our economic auditing service, which includes our joint audit offering with leading technical security auditing firm Trail of Bits. This is called Mainnet 360. We'll be announcing our first completed joint review later this month. And today we're excited to launch our entrance to economic analytics with leading crypto analytics firm Flipside Crypto. I'll hand it over to Matt Bridges of Flipside Crypto for a quick introduction, and then I'll share today's agenda. Matt?
Awesome. Thank you, Reed. Hi, my name is Matt Bridges. I'm the CEO at Flipside Crypto. We provide analytics solutions to protocols and projects to help them grow their networks, like Reed mentioned. Just a little bit of history on Flipside. We started out as a data-driven cryptocurrency fund. And a core part of that fund strategy was to use data from many sources to track overall project health. We quickly realized that the market was really eager for that kind of data. So we started to publish what we call the Fundamental Crypto Asset Score, or FCAS. And today that FCAS rating is distributed by some of the biggest names in crypto. So like CoinMarketCap, Nasari, MarketWatch, The Street, and more, you can find that FCAS rating. Now, a rating by itself could be used as a signal or a high-level assessment, but if you're a project or a protocol, what you really need are actionable insights that lead to customer growth. So answering questions like, where should I focus and what action should I take to grow the network? And that's really our primary business today, providing those analytic solutions that help projects assess and drive customer behavior. Many of those insights and actions that protocols and projects should take, especially for those that are in the early stages, a lot of those questions are economic in nature. So when Prysm first approached us to kind of co-create this econometric suite, we knew it would help answer some really important questions and some of the toughest questions that we get. Questions like, what are the drivers of my assets price? And are the incentives I have in place having the intended effects? So those initial conversations have led to an awesome partnership between our two organizations. We've created some sophisticated economic models together and some tools to help answer these questions. We packaged them up into a nice product with real data. So I'm really excited about this, and I'll hand it back over to Reed to talk about the agenda so we can get to the good stuff.
Great, thank you, Matt. Very excited for this project and for today as well. So today we'll be holding a product demo of what we're calling the Crypto Economic Analytics Suite, showcasing live data from the token Aeon. Today we'll have Angela Minster, data scientist at Flipside Crypto. Angela has a PhD in statistics from Temple University. We'll also hear from Stephanie Herder from Prysm Group. Stephanie is one of our founding economists. She has a PhD in business economics from Harvard University. Following background and product overview, we will then be joined by Sam Pajo-Phipps of the Open Application Network. Sam is head of strategy at the OON. This is the project powered by the Aeon token. We'll also be joined by Terry Rossi, principal at Blockchain Ventures. They're a leading VC investing in cryptocurrencies and blockchain technology companies, including Aeon and many other leading projects in the space. So we'll then conclude by a technical overview from Matt here. So without further ado, I welcome Angela and Stephanie. Thank you very much, Matt. We'll see you in a minute. Hey, hello, Stephanie. Reed. Hi, Angela. How are you both?
Doing well. So it's great to be joining. As you said, we're really excited about this project. I'm going to start off with a brief overview of the genesis of sort of how this project came about and the big picture questions that we're trying to answer. So as you've mentioned, at Prysm Group, we've worked with literally dozens of projects on economic design and economic audit. And over again, we get the same types of fundamental questions. So what are the levers driving my token price? Is my mining sufficiently distributed? What does that even mean and how do we measure it? Are mining rewards fair? Right? Are we compensating people appropriately given what they're doing? Is my platform user-friendly and something that consumers would like to use? And as we talk about at Prysm all of the time, these are really economics questions. So when we think about what is economics, at a fundamental level, it's about the study of choice, right? So if you're running a blockchain platform, you need a number of different stakeholder groups. You need validators and token holders and users to come to your platform and use it for things, whether it's for investing or mining and getting block rewards, whatever it is, you need different groups of people to think that your product is what they need to get what they want and to choose to use it. And so understanding how people make choices and how your platform can adapt to get people to make the choices that you want is essential to launching a well-functioning blockchain platform. I mean, we say all the time that blockchain projects are mini economies written in code. And when we think about economic design, as I said, you have these different groups of users, all of them have different objectives. They're coming to your project. And one of the most important things that a project design team will decide is what are the different economic design elements of their project? What are they going to charge for different services? What are the rewards they are going to get? What are things like pricing mechanisms? And when you put the user's goals together with the design, you get economic outcomes. And so trying to understand what are these three different components and how the design can be changed so that you get the outcomes you want is really what our work is all about. At Prysm Group, we use an economic framework called the House. I won't go through all the different layers, but what this does is it's a bottom-up construction of the different types of tools that blockchain platforms can use to get different outcomes that they can use to shape behavior, to get groups to work together. And through the course of working with many different projects, we have developed a number of different formulas and algorithms that we use in our work to understand what's going on in different projects and to try to make recommendations about how projects can improve their design. And one of the core challenges that we have is that many of these metrics require a level of data that's not commonly available, right? If we're thinking about token price decomposition, if we're thinking about mining behavior, without that advanced data engineering and that data infrastructure, it's very difficult not only to compute these values, but to track them over time. And this is what's so exciting about our partnership with Flipside, because as Angela will talk about, Flipside has this really unparalleled data that they collect. And when you take their data insights and combine it with these economic frameworks, you can get some really powerful insights. And we're going to be talking about those a little bit later. And the questions we're really trying to answer are things like, is the platform achieving the economic outcomes that the design team wants, right? Is this doing what the founding team had hoped? And if not, how can we change the design to change these outcomes? And just really briefly, as you'll see, in order to come to some of these insights, we end up using and constructing a number of different metrics that are just used in different economies. So the equivalent of GDP, things like token velocity, money supply, these are all essential ingredients that are included in the dashboard that allow us to start thinking about blockchain projects from an economic point of view. And that's why this is so exciting. So I'll hand it back to you, Reed.
Great. I think we'll hear from Angela.
Yeah. Hi, I'm Angela. I'm a data scientist with Flipside Crypto, and I've had the pleasure of working with the Prysm team to build out this amazing econometrics product. It's been really exciting to work with Prysm because right from the start, we found that we really take the same approach to how we think about blockchains, specifically the question of how do we turn tons and tons of raw blockchain data into analytics and metrics that drive the BI tools that we have developed and turned into products to help crypto projects and also the other people who use crypto projects. So on our side, it begins with a good foundation of underlying data. We have a process that we call chain walking, where we ingest raw blockchain events from many chains and organizes them in a way that makes each individual chain useful, but also in such a way that we can easily calculate similar metrics and do similar analysis from chain to chain to chain. and even at the top level have metrics that are comparable from chain to chain, even though the underlying data can be wildly different from project to project. From there, we dig into what's really going on in a chain. So for us, that means understanding what addresses are doing, which means understanding what type of entity might be controlling an address, be it an exchange or a miner or an individual user of the project. And then from there, when we understand who's on the chain, we can switch to what are they doing? What type of transactions are people engaging in? And so I got distracted by the chat, so unprofessional. So from once we know who's doing something and what they might be doing, we can start to map out the overall grand scope of what kind of things are happening on a blockchain. So that might be things like mapping out every chain's exchange ecosystem, or tracking all of the miners, validators, or stakers to see what they're doing with the rewards that they earn. And then we also map out other kinds of common behavior, like what smart contracts are doing, and if there are dApps on the chain, how active they are, and what they look like, and their ecosystems as well. So then once we know all of that, we can start to answer things like, what is happening on this chain? And in terms of what does it mean to say what's happening on a chain, a really good example is something that we think about a lot and has happily had a lot of overlap with the way Prysm thinks about things, and it's how do you break out the difference between speculative and consumer behavior on a chain? So we want to break this out because we want to know if a chain, or maybe even an ERC20 token, is actually being used for the reason the chain or token was invented. Or on the other hand, is it actually being used primarily for speculation? Now, I'm not saying that speculation is entirely bad. Every chain will have its own share of speculation, but of course, if a chain is overwhelmingly driven by speculative behavior, that's definitely cause for concern. So for us, understanding the breakout between utility usage versus speculative is one of the things that could be happening on a chain that we feel is critical to understand a blockchain, especially from this BI and analytics tool building perspective. And this has really been a concept that's driven our products and analysis since day one. And so that's one of the ways that we're really overlapping with Prysm and the way that they think about a chain, and made us super excited to get started working with them on this project and see how their different perspective from the economics approach relies on the same concepts, and we could work together so well to build this product. And now I will hand it over to Stephanie to actually talk about those metrics.
Great, Angela. Thank you very much. And so Stephanie will be now diving into showing some of the suite, and we'll bring on both Matt and Terry as well. Hey, Terry, how are you? Hi, Matt. Hi, Sam.
Hey, everyone.
Great. Stephanie, if we could pull up, if you can continue with the presentation, and then we'll look into some of these metrics and get some of the input from both Terry and Sam.
Sounds good. Hello, Terry. Hello, Sam. So as Reed said, we're going to be spending some time just going through and showing what this product can do and why we're so excited about it. So as I said in the introduction, what we're really trying to understand here is a project achieving the economic outcomes that it wants to, that the team had in mind when designing the product and thinking about the target user base? And if not, how do we change the economic design to get the outcomes that we want? And when we think about this, as I mentioned, there are different groups of stakeholders. And in designing the suite, we thought about how do we provide different types of metrics that target the value that's being delivered to different token holders. So for different stakeholders. So for example, for token holders, Sometimes, depending on the project, you want the token to have a relatively flat value. Sometimes you want the value of the token to be going up over the time. But regardless, it's really important to understand what is driving token price. How is the token being used? Is it being used? This all gives indications of, is the token delivering on what it's supposed to do? For validators, we really think about distribution and we think about fairness. So we put together a suite of metrics that address that. And then finally, what we're calling users are people who are thinking about, using a token to buy and sell goods and services. Is this a consumer-friendly platform that can be used in the way that's intended? And so we're going to be going through an example for each of these different sets of stakeholders to show exactly how we've captured these different metrics and why we think that they're really important. So as we mentioned, we're very fortunate that we're able to work with the OON and its AON token to build out the prototype for this product. So the OON is a public infrastructure that builds on new open applications. The digital asset is called AON, so we'll be referring to the AON token. And one of the pieces that we'll come back to is that in November, I believe, Sam, the OON changed from just a proof of work consensus mechanism to a really interesting and novel combined proof of work and proof of stake alternating consensus mechanism. And as we talk about, especially some of the validation metrics, we'll talk about what did we expect to see in terms of this transition, and has it become apparent in the metrics that have been designed? So first, I want to dig into some of the metrics that we're thinking about for token holders. So when we work with platforms launching a token, as I said, the questions we get are very similar. What are the main drivers of the token price? How much of my token is driven by speculation as opposed to consumer demand? And how is this changing over time, right? If there's a big move in my token price, is it driven by fundamental activity? Is it driven by a news announcement that was just made? Or is it something completely, orthogonal to the decisions that the platform management has made? And when we think about what are the fundamental value drivers of a token, it really depends on what is the token used for, right? As we see more and more different projects, we see different ways that tokens can potentially be used by either investors or consumers. So sort of the classical model for many tokens that we work with are the utility token model, or a means of payment, right? The token is what you use to buy distributed storage or goods and services or whatever it is that the project itself is offering. Obviously now we have things like staking tokens, where the token has value because if you stake it, you get a stream of rewards, right? That delivers fundamental value. For security tokens, the token gives the right to some kind of outside asset, maybe a share of a building or a piece of art. And so in order to decompose a token into its component parts in terms of value, you have to understand how is it being used and how do those different uses deliver value. So the exact decomposition of each token's value is going to vary depending on how the token is used, and vary depending on the specific design decisions that the platform founders have made. So for the AON token, as I mentioned, there's this very interesting novel consensus mechanism. So the AON token, and Sam, correct me if I'm wrong here, the AON token started out as a means of payment. And now because of the staking element of consensus, it's also a staking token. So when we think about the value drivers of the AON token, it's going to be a combination of means of payment, which we sometimes call consumer activity, and these staking rewards. And so our goal in decomposing what are the different value drivers of the token price was figuring out what is the fraction that can be attributed to staking, what is the fraction that can be contributed to consumers needing the token because they want to buy stuff, and then what's remaining, which is driven by speculation, expectations, and these other types of what you could call more ephemeral activities. And so what I'm going to do now, which I'm very excited about, is I'm actually going to move over to the dashboard. So this is the very first crypto economic analytics suite dashboard. As you can see, we have a variety of different things. And I'm actually going to pull up the token price decomposition for the Aeon token for the past 90 days. So this is what you see here. As you can see, the Aeon token price has ranged between about 8 cents and about 15 cents. The token price is this navy line here. And using the metrics that we've developed, which I mentioned have a whole bunch that's based on the economic literature, it's based on fundamental value drivers, which we can talk about more. We found that most recently, and this is for May 1st, of a token price of about 8 cents for the Aeon token, about 5 cents is driven by what we call the consumer component. So these are users who want to buy goods and services who are taking the token and using them to conduct consumer activity. This is based on a metric that we call economic activity, which is kind of like GDP of an economy, right? It's real purchases, it's real economic activity. The staking component and the staking rewards are slightly less than a cent of the 8 cent price. And the speculation component, or so the expectations component, is a little over 2 cents, right? And so what you see here, which is great for the OON, is that speculation is a non-trivial part of the token price, but it's not the fundamental driver, right? The fundamental drivers of the token price are real drivers of economic activity. They're the staking rewards, they're the need to buy goods and services, which is really, really exciting to see sort of robust activity. And one of the things that this allows the platform management to do is to understand, if they do want to think about how do you manage your token price, there's already a significant consumer component. Can you raise that? If you were to increase staking rewards, what would that do? It really starts to give the team an understanding of the levers driving the token price, so then they can be actively managed. So Sam, I'm happy to hear some of your thoughts on this.
Definitely. Yeah, like I overall, this graph is just such a great high-level overview of what are the components of token price, and for a project like Aeon, is really valuable for us to have this view so that we can understand what are the drivers and then what are the strategies that we're putting in place and our community is putting in place, and tracking that impact on these components. So for me, top of mind when I look at this is it's great to see that we have a fundamental kind of strong value over time of consumer components based on the current activity on the network. And for us moving forward, as we build out our product Moves, that is a consumer product, it's going to be really powerful to have this tool so that we can understand how the components that we're building on the network and how they're interacting with the consumers actually translate into value in the asset. So over time, we can start to see when we have particular launches, for example, let's say of a peer-to-peer lending mechanism in the future, what impact did that have on the consumer component of price? And I think when we look at that and we have the speculative component, what's helpful for us to look at is if there was an event and there was a new component, let's say, that drove consumer activity and we saw a significant uptake, what happened to the speculative component in response to that? And what is the relationship between consumer value drivers and speculative value drivers? Because I think that we can start to understand how our communication as an organization is performing. So what I mean by that is if you have lagging speculative components, i.e. people are not understanding the new consumer activity that is happening, that might mean that we have kind of an information asymmetry problem as an organization. We need to spend better time educating the world around us of what are we building and what are the value drivers and what consumer activity is happening on the network. So this allows us from a high level perspective to understand the performance of those consumer components and then how speculative activity relates to those. The other thing that's kind of top of mind for me as I look through this is really monitoring speculation in isolation as well, because if we're starting to see speculation kind of grow without fundamental value drivers from consumer activity, that can raise potential concerns around the volatility of the price. So if we're starting to see significant uptakes in speculation where more and more people are kind of routinely trading on exchanges, that can result in increased volatility to the asset. And that not in its own might be a problem, but when we look at the impact that price has to consumer activity, it can be. So if users of a particular product are relying on the value of Aon for some type of denomination for a good or service, and the value of that base currency is highly volatile, that could potentially challenge the fundamental kind of business model of that product. Or for the operators on our network, the validators and the miners, they have particular costs to running their operations. And if there's significant volatility and they have kind of CapEx expenses over a long period of time, that can also break their economics. So this view really provides us a quick snapshot of, okay, what are the major drivers to value? And then how are our strategies performing? And can give us insights into, do we need to spend time potentially speaking with some of the operators on our network to understand how this volatility is impacting them? Or do we need to do a better job communicating, because we've seen great consumer growth, but it's not translating potentially into speculative growth? So those are the things that are top of mind for me looking at this.
No, it makes a lot of sense. And I think one thing that you've mentioned that I agree is that especially for a project where you guys are aware of what are the different apps running on your network, it's much easier to take active steps to understand and regulate, to grow consumer activity or whatever it is. If the fundamental driver of your token price is speculation, there's less that you guys can do, especially if you want the token prices you're saying to be relatively stable. And that's a target that a lot of projects we talk to have. If you're launching something that's meant to be used basically as a currency or a means of payment, people typically don't really like highly volatile currencies. They're just not attractive. And so, you can get sort of more of a handle on your ecosystem if your token value is really, consumer driven.
Yeah, and just to add to that, Stephanie, just speaking from the perspective of an investor in Aon, the fact that usage is the largest driver here is really encouraging as a venture investor. As venture investors, we're long-term holders, so we're driven much more by the fundamentals of a project than we are by the short-term volatility of a token. And so our gains as investors will come from fundamental growth of the platform over time, as opposed to capturing short-term swings through a shorter holding period. So all that is to say, it's really encouraging to see that the driver of Aon price is from real consumer usage and not just from speculation or from staking. And this is consistent with what you'd expect in a traditional equity investment in a non-blockchain company, right? Like usage, traction should be the long-term drivers of value accrual to the equity, to the token, much like how traction and revenue growth are the drivers of value accrual to equity in a non-blockchain company. And I guess one other question, not as much of a statement, but a question that occurs to me from this is, it's interesting to think through what the security ramifications might be to how much staking is driving the price. Like for instance, if staking is a much weaker driver than speculation, does this mean that speculators have a disproportionate influence on the economic security of the network because they affect the token price so much and therefore the value of the amount of stake locked up? Obviously some speculation is healthy in any token economy, but at what point does it become a security risk?
Yeah, no, I think that's a really great question. Another thing that I think comes up, and you alluded to it with the staking driver, is that there are some projects we've seen that in an effort to get their token price up, they implement staking rewards. And it can either be part of consensus or it can be some kind of sort of interest payment to users for locking up your tokens. And I think what this highlights is that can benefit your token price, but it can't be the only thing driving your token price. You really do need to see this healthy consumer demand piece, or if you had a different design of tokens, or there needs to be more than just staking rewards in order to drive your token. Because you do see here that the staking returns for Aon do add about a cent to the token price, but they're by no means sort of the entire value. And so,
I think that was definitely top of mind for us when we even did our work together last summer when we were designing kind of the reward structure. And it's nice to see it kind of presented here, which is that, you could definitely increase the total rewards given, but it has a cost. It's not just something that you can just continue to print out. And eventually the amount of new supply that's going to be hitting kind of the market because of that is going to have a negative impact on price. So I think it's important to find that balance of, first of all, you need fundamental consumer activity that's actually driving demand into the system. And then you need to I think, set objectives for the security of the network. And that was top of mind for us when designing the reward structure was, what are our needs for security based on the usage of the network? And then let's design the economics to meet those objectives, and make sure that we're always kind of growing consumer demand kind of in parallel to that, so that we're not in a place where that we're subsidizing the security of a massive network without any actual consumer activity to secure, if you can think about it that way. So
exactly.
Yeah.
All right. Let me go back here. And one thing I mentioned, and we're going to go back and forth between the dashboard, is that in order to construct a lot of these variables, we ended up having a sort of what you might call intermediate set, but really sort of what I would call these fundamental monetary policy and economic activity variables. So these are the types of measures that you would see on the website of the Federal Reserve for the dollar. You know, the European Central Bank is going to be putting these out. And they're the types of things that you use when you compare different national economies and different currencies to measure their health. You know, things like not just total token supply, but token, circulating supply broken down by the degree of liquidity, right? That's something that you'll see for pretty much any major currency, and we developed that here. Things like token velocity. I know that there's been increasing discussion of sort of what's the velocity of Bitcoin. The data here allows us to get to this at a very precise level that's comparable with what, you can take the values here and compare them to what you see for the dollar, right? It's that level of precision. And then, as I mentioned before, what is the level of economic activity? And this is something that Flipside has thought a lot about, we've thought a lot about, and have converged on these metrics that just are really fundamentally useful measures of economic health for blockchain-based ecosystems. All right, so the next that we want to talk about is validator rewards, and this is something that's really exciting, especially because of the change in consensus mechanism that Beyond undertook last November. And so when we talk about, we sometimes call them, mining or validating marketplaces, because it's fundamentally, there's supply and demand of transaction processing. But we hear all the time, is my network decentralized? Maybe I know how many mining pools there are roughly, but if we look at actual block production, is this decentralized? How do we even measure this? Are our rewards big enough, right? What are the rewards to miners and stakers? What's the rate of return they're getting? And is the allocation of rewards fair? This is something we get a lot, especially with respect to bigger versus smaller pools, right? Am I being fair to my small mining or staking pools? And so the set of variables that we're using in this particular suite really attempt to get at these types of questions. And so today, we're going to be focusing on the decentralization of block production. So trying to understand for Aeon, how decentralized is the block production, and how has this changed with the introduction of the new consensus mechanism? And to measure this, we use a metric that's called the HHI. And this is a metric that's used frequently in economics to measure sort of the degree of monopoly or distribution in a particular market. So the HHI metric that we've designed, that we're using here, varies between 0 and 1. So if you have an HHI of 1, it basically means that you have a monopolist, right? So in the case of block production, if you have an HHI of 1, you basically have a single address producing all of your blocks, which if your goal is a highly decentralized network, that's not a great finding. On the other hand, it would be very difficult to get exactly 0, but if you have an HHI that's approaching 0, it means that you have many different either pools or miners or validators producing blocks over a given period of time. So you have a high level of decentralization. And so with these particular metrics, we wanted to understand over a given period of time, how decentralized is block production and how is this changing over time? And so with that, we will go back to the dashboard. And here we are. So the HHI is the short name for something called the Herfindahl-Hirschman Index, whose full name is rarely used because it's long. It's typically called the HHI. And so this is the HHI for block production for the OON. And we've started in January, and this goes through May 1st. And so one thing to understand here is that the exact design of the consensus mechanism Unity is that they alternate between producing a block by proof of work and producing a block by proof of stake. So it goes back and forth. And so what we've been able to do here is to compute the HHI for the proof of work chain. So if we look over the past 90 days, how concentrated has block production been for the proof of work blocks, how concentrated has block production been for the proof of stake blocks, and what if you put this together? So this purple line here is the HHI for the proof of work blocks, and you can see that it's ranged between 0.35 and 0.5. So this is quite a high number, and this is one of the reasons, and Sam will talk about this more, that the OON pursued this updated consensus mechanism, because this is quite centralized mining. If this is what we're going on by itself, there might be concerns that there aren't sufficiently many different block producers producing blocks. For proof of stake, we have an HHI that's extremely low, right? It's below 0.1. And so this shows that a number of different staking pools are producing blocks over a given period of time. There's a good distribution. And if you put them together, you get a number that's about 0.13. So this is the combined line here, this green line. And one of the things we're able to do using Flipside's huge suite of data is to introduce benchmarks. So we are able to compute these equivalent numbers for Bitcoin and Ethereum. And so you can see them here. So the HHI for Ethereum is a little less than 0.2. And for Bitcoin, it's slightly lower. And so what you can see here, which is so interesting, is that the introduction of this proof of stake has really brought the OON's level of decentralization down to benchmarks, right? If we were up here sort of by the purple, that's a lot of centralization. Introducing proof of stake has really sort of brought these values down to comparables, which is a great outcome. So Sam, I'd love to hear you say a little bit more about sort of what you were hoping for, and does this validate what you guys were expecting to see?
Yeah, thanks for going through it. So I think this is just an amazing graph for the perspective of, it kind of tells a story of how we've worked over the past almost year at this point around kind of our views towards consensus. And it kind of shows a theory that we had last summer, and then the actual tangible outcomes that it had on the network as we are today. So yeah, in the summer of last year, we were still running as a proof of work network, and we had launched in April of 2018, running a proof of work network. We had a unique mining algorithm that we implemented, but we faced a lot of the challenges that most minority proof of work chains face in terms of concentration and the cost of attack. So we spent the time over the summer to really dive deep into what a incremental movement in security could look like, and an incremental movement in a more decentralized block production that wouldn't be an effort that would take kind of years to build. It was really focused on what can we do now, leveraging the proof of work that we have and the benefits of proof of work, but introduce the ecosystem that we have with proof of stake and the thousands of individuals that hold Aeon, and start bringing them into the security model of the network. So that was the design of Unity. Unity is an alternating consensus mechanism where every second block is proof of stake. So one proof of work, one proof of stake. And I think this graph just shows kind of the outcomes of that. Was originally just as a standalone proof of work network, we had this HHI score that I think was not optimal for kind of the objectives and the vision that we had as an organization. And then the introduction of Unity, if you look at the total score, I think really now shows not only the incremental improvement that we were able to make, but starts to set a foundation by which we can now make more improvements if we wanted to bring that even lower. So I think this is kind of an important distinction when you look at kind of the broader consensus discussions that happen across many organizations. Is they're very theoretical, and that's great. And then if you can put them in practice in an incremental way, and hopefully in an agile method where you can actually put them out and test in a short period of time and then leverage analytics like Flipside's and Prysm's dashboard here, you can actually prove the outcomes quite quickly and validate those. So I think this is just very helpful to kind of understand the outcomes of Unity. The other thing that I think, just in terms of how we plan to use this graph operationally moving forward, is really how the various actors in this market mature or change over time. So we launched Unity in November, so it's been up and running for quite a few months now, but there's just time is going to have impacts on these operators. And we have over, for example, on the proof of stake side right now, we have over 40 individual validators, but they range from very large operators that kind of run as a business model to very small niche independent operators. And time will have an impact on these individuals in terms of their cost of operations, their revenue model, how the fee market changes with competition, how the Aon price changes. All of these things are going to have an impact on, do we see more concentration in the staking ecosystem over time, or do we potentially see incentives for it to expand? And depending on those outcomes that we can track here, we can come up with strategies. So as a team and as an organization, we could say, okay, let's come up with strategies because we're seeing an increased HHI score. Let's find ways to incentivize more smaller individual validators to participate because we're starting to get to potentially a benchmark that we find concerning. But looking at these numbers sorry, I was just going to say one more thing, that looking at these numbers in isolation is really difficult to know, okay, am I good or am I bad? And I think what's really helpful here is just seeing the comparables of benchmarks with ETH and BTC, and with Prysm and Flipside, that can become more and more. You can start having 50, 60 chains where you could actually benchmark yourself against. And that's just really powerful, so that you can actually understand how you fit in the overall landscape.
Yeah, no, it's definitely, I think this is a perfect sort of set of metrics, especially for you guys. Terry, I'd love to hear, as an investor, when we first developed this metric, I really, thought of it as sort of being in the weeds, but you've had some really, profound insights about how this is useful to you. So I'd love to hear about that.
Yeah, definitely. Well, I think for starters, I think the level of decentralization that this HHI score shows for Aon is really encouraging. And mainly that's because I think, and this is really related to our own thesis on investing in the space, but as we see it, decentralization is really the foundational property for all of these systems. And I think oftentimes people in the industry can talk about decentralization like it's an end to itself, but really it's not. It's actually, decentralization is what produces these unique properties involving trust and transparency and censorship resistance, and all these other things that we've come to value in blockchains, and that more importantly enable this brand new category of applications to exist that we're all excited about. And at least as a fund, our goal is to invest in companies that are building new categories of business using the blockchain, and decentralization is an essential part of realizing those novel properties. I think more broadly, it's also good to see that in this case, the introduction of proof of stake on Aon has reduced consolidation and block production. I know there's a lot of fears in the space about proof of work and how that has led to consolidation on a number of blockchains, including Bitcoin and Ethereum. And it's good to see that the introduction of proof of stake is reducing that, and it's a good preliminary indication that it's working as designed. And to Sam's point earlier, I think it'll be really interesting to see how this changes over time, and particularly as staking services and pools mature. And I wonder, what, if any, are the drivers of consolidation and proof of stake, and to what extent we can even measure them. So for instance, in proof of work, the drivers of consolidation are things like the centralization of hardware manufacturing in certain regions, and the concentration of miners in regions with cheaper electricity rates. But for proof of stake, maybe it'll be the DevOps requirements of running nodes, and maybe that could be a leading driver of consolidation. So it'll just be interesting to see. It's still probably too early to tell, but and another question related to that is just how can we even measure that consolidation across different staking providers and across even different cloud platforms if they're using cloud platforms, and how much can we even measure on chain?
No, I agree with you, and I think that there's sort of the platform level metrics, which in and of themselves are extremely interesting. But then, of course, when you see this, the first thing you think is, well, I want to see this for 20 more platforms, right? And I want to see aggregate industry trends of consolidation of proof of stake, and if it's occurring, what's driving it. So, I agree.
And one other thought on this super quickly is just as a larger token holder and investor in Aon, it's really important to think about our own impact on concentration, because as we stake, we're included in this set, right?
Yeah.
So we need to think about how we allocate our stake to different staking pools and different providers. And that's good not only for us to diversify our own risk, but is also good for the network. And so in that way, our interests are really aligned.
Yeah, and
That's a really good point.
One more point that I might just kind of point out here that I think is interesting is just the idea that this is almost a standardized index, right? So right now we're seeing it for us, but similar to like how FCAS created a system where you could get a really good sense from a standardized approach of what is the activity happening on a network. This is a very concise way of understanding across the industry of what does concentration look like within these networks. So we're happy to be a part of it.
Sounds good. I look forward to seeing how this evolves over time. Just to jump back in, as I mentioned, there's more metrics that we have that are measuring the health of the validator market. This is one of them, but we also spend a lot of time that we won't get to now, but we talk a lot about fairness, sort of how we're small pools versus large pools being sufficiently rewarded. And we also develop metrics of staking power. So I know when we worked together last fall, Sam, one of your questions was, what is the return we're giving to our stakers, right? And how does it differ between the nominal measure in Aon versus the real measure taking into token price? So now we have a formal suite of rate of return for various different participants that'll be really helpful to think about, what are their outside options and what is the return that's being expected. All right, and so finally, with our last few minutes, we want to talk about some of the ways that we're thinking about, for lack of a better term, user friendliness. And so this is really thinking about if you are introducing a token, or your platform is supposed to be a competitor to something like PayPal or Venmo, or just sort of a standard means of payment. Is the platform doing its job? Is this a cost-effective way to transfer funds? Fee volatility. We know from everything from the CryptoKitties crisis in 2017 through MakerDAO a few weeks ago that unexpected fee volatility can put a real wrench in for projects that are just trying to use the platform to transfer funds. So do we see a lot of volatility? And then also, do we see users having to overpay because they don't know what the going rate of transaction fees are? And so for this section, the metric we're going to be talking about, which is one that I'm very excited about, it's based on some research that was done out of University of California, Berkeley, is what we call the uncertainty surcharge. And this is a metric that you can compute for any kind of protocol where the transaction fees change based on supply and demand, right? So anything where fees go up when there's more demand, or fees go down when there's less demand. So the idea here is that when there's more demand for transaction processing than supply, and this demand increases, the price is going to go up and the price is going to go down. And this is how we think about allocating this scarce space. The problem becomes sometimes these price movements are hard for users to detect. Sometimes they move very quickly. And as a result, you'll see both exchanges and users just saying, I have no idea what the going price is. I don't want my transaction to get stuck. So I'm just going to overpay. I'm going to overpay the market price, potentially by a very significant amount, so that I don't have to worry about what is the going rate for transaction processing at this time. And this kind of systematic overpaying really shows that your pricing mechanism isn't working. And you're charging people more than you should because there's a lack of clarity and there's also a lack of communication. And so the final set of metrics that we will show here is this uncertainty surcharge. And at a fundamental level, as I said, what this is a measure of how much are users sort of paying over the going rate in order to ensure that their transaction doesn't get stuck. And ideally, you want this to be low, right? So this is saying that, yes, there's a going price and it's going to be changing over time depending on demand. And that's fine. But this is how much are you overpaying even with respect to that. So what you can see here is that over the last 3 months, this uncertainty surcharge for Aon has been steadily going up. So it started at about 14% and it's gone up to about 26, and now it's coming back down. And what you can see, which is really interesting when you put this together, right now it's about 20%, is that this increase is in line with an increase in gas price volatility. So if you look at gas price volatility, you can see that over this same period, the gas price was becoming more volatile on the for the Aon token. And so as a result, you see users are saying, I don't really know what the gas price is, but I'm just going to pay you more than the going rate. And so this is sort of an indication, if this gets too high, that your pricing mechanism might not exactly be doing what you want. And so you might also ask, sort of, what is the value of this, and is this high or low? We also computed this for Ethereum, and hold on. Turns out Aon is doing great. So if you compute this equivalent metric for Ethereum, it's between 60 and 70%. The originators of this metric computed this for Bitcoin, and it was around 80%. And so this really shows that although there's room for improvement, overall, so there is a not excessive overpayment of transaction fees for users of the Aon. And actually, for this final one, I'd love to go to Terry for your thoughts on this, sort of as an investor.
Yeah, I think the first thing that pops into our minds as investors here is user friction and poor user experience for if there's a lot of gas price volatility. This is the kind of a prime example of UX friction that blockchain applications have in the entire space. And in a perfect world, maybe users wouldn't even have to deal with any of this or any financial uncertainty in order to use an application. And I think an extension of this as investors and as teams building on these protocols is, how can we concentrate this friction to the fewest number of participants possible? Can applications or businesses handle this complexity on behalf of their users so that they're not exposed? And maybe the protocol can even do this themselves so that the developers aren't even exposed. I think lastly, this is just an interesting factor to consider as businesses are choosing which protocols to build on. Like, they might choose the protocols that offer them the least friction to their user and to themselves as they build their apps, and offer them the most predictability around their costs. Businesses, it makes sense, don't really want to expose a lot of issues and uncertainty to their users over which they have no control. So the protocols that handle this best or have the best tools to manage this may have a significant advantage when it comes to developer and user adoption. Yeah.
And Sam, you had a really great point that, overpaying may seem trivial, but can actually have a really profound effect on the financials of projects building on these protocols.
Yeah, like I guess to echo a little bit what Terry said, like when we look at, or for most networks that are operating in this space, you're really providing an infrastructure for people to build businesses or build products. And when you're building a business or a product, you need certain levels of certainty. And if you have too much uncertainty, you have too much risk. And that uncertainty is really important to control. And I think the challenge that a lot of these networks face, and us included, is that uncertainty can be so volatile that if it starts to move outside of particular bands, it can actually break the fundamental economics of a business. So if you're creating a consumer product that is doing any type of interaction with an individual, and the cost of that transaction increases significantly over a small period of time, and potentially the margin that you're generating in that is so low that you might not even be able to feasibly do that anymore. So I think it's really important that this is something that organizations understand and continue to track, especially in regards to the individuals that are using the network, and what type of businesses are they looking to build, and how does this uncertainty and how does this transaction fee market play into the economics of their business.
Yeah, no, I think it's a really good point. And one of the things we've talked about, when you see these numbers is this being driven by exchanges, and what is the bidding strategy of exchanges versus apps? And what you'll see for some exchanges is they sort of just set a above market price and leave it. And you might say, well, okay, that has limited impact, but that reduces the amount of supply available for everybody else, right? So everybody else in the market has to respond to this and either compete for reduced space or increase the amount that they're paying. So even though you think you have a well-functioning auction mechanism that's setting a market price, this sort of reactionary bidding because you don't really know what the price is, and so you're just going to overpay, has really negative impacts for everybody else who's trying to use the project. So
definitely, and it makes you think about, okay, well, what can be done to improve this, right? And I think there's obviously some very technical, or there are technical new, like designs and innovations that can be made to make this better, and a lot of them are being discussed and being implemented. But I also think there's just a role for education and communication. Like, so much of this comes down to consumer behavior around uncertainty, and I'm just trying to do a simple transaction, and the value of it potentially is inconsequential. I'm just going to round this up to an order of magnitude. And a lot of that comes down to what Terry mentioned around user experience. So I think there can be very low hanging fruit to bring this down.
Yeah, and I love that you say that. We talk about education all the time. You know, these platforms are not trivial to use, especially if you're not sort of a blockchain intense person. And so just realizing that there needs to be instructions and UI and just ease of bidding is something that we're big fans of. And I definitely agree with what you're saying. So I think we're almost out of time here. The one thing I will add very briefly is that, you know, we are building out and we're continuing to think about these types of user friendliness metrics, and how do you measure that this is something that, you know, people actually want to use for day-to-day activities. And so with that, it has been a real pleasure to go through this with Sam and Terry. Thank you both for coming and offering your thoughts. And I will hand it back over to Reed.
Great. Thank you so much, Stephanie, Sam, and Terry. That was a very insightful conversation. Special thank you to Aon for allowing us to display this data today. Thank you guys very much. We're now bringing back on Matt as we just do a quick outro. Just wanted to mention that we picked these 3 graphs as a preview for today to show metrics from different stakeholders, including token holders, validators, and users. The full crypto economic analytics suite has more equally valuable graphs. So very happy to connect with any projects who are interested in learning more. With the last, I guess, 4 minutes, I'd like to ask Matt to provide an overview of chain walking, which is the tool that makes all of this possible. Hey, Matt.
Yeah, thanks, Reed. So how do we get started? I think that's a question that we hear a lot. And for Flipside to start to ingest data and get it into a queryable form and a comparable form to all the other chains we've done, we have a technology called chain walking, which is what really starts it all. And chain walking is the process through which we ingest blocks off of different blockchains. If you're a project that's built on a blockchain we've already chain walked, that's great. We've got a head start. And if you're not, then we work with you to understand how your chain works, build a parser, and get your data into what we call the universal data model. So the universal data model is the thing that allows us to do things like the benchmarking that we just showed in the product, as well as take algorithms for doing things like finding exchanges on blockchains and applying those same behavioral patterns to new ones that we're walking. The chain walking process itself, it's an engagement between Flipside and a little bit of developer involvement from the chain side, just so we can make sure that we're parsing blocks correctly and understand all of the subtle nuances of each individual chain. It usually takes about 4 to 5 weeks, and then it's another, maybe 2 weeks after that before we can get to a dashboard in a product like we just showed for the Econometrics suite. So, a 6 to 8 week process from 0 to something like we just showed. So that, if you want to learn more about the chain walking process, it is a kind of a technical process. You can go to flipsidecrypto.com/chainwalking. There's some technical documentation for developers about how to actually implement this, and also just some general information about the process for more business stakeholders. With that, I will say I think we're running up right on the edge of time, and it's been an absolute pleasure to work with the Prysm team from the Flipside side, and also huge thank you to Sam and Terry for allowing us to work with you and iterate on this product as we bring it out. So thanks everybody, and appreciate your time.
Thank you guys.